Well, we'll jump straight into it, Chris. Thank you very
Cool.
much for joining me. So to some of our clients have been asking us what the investment committee do. And I thought that it might be good to just go back to basics and run through everything from the asset classes we invest in, what your options are between using just an index and an active fund manager, what that means when I say index versus active fund manager, what options we have available, and just trying to really kind of start from the absolute basics and build our way up to how we actually start to put together a portfolio. So to start off with, I wanted to talk about the four main asset classes, and we might even touch on currency and alternatives as well. But essentially, there's four main asset classes: cash, fixed interest or bonds, property and infrastructure. We typically classify that as one, and shares, equities. So we'll start with probably the simplest, which is cash. Now, cash by definition, the money in the bank that you have, cash that you have available, it's daily liquid. It's not locked up. It pays usually the smallest interest rate, or let's call it the smallest return, because obviously there's things you can invest in that don't pay an interest rate, but there's typically no capital growth on it. You put $100 in. It's daily priced, so each day you should be earning a very small amount that might equate to currently 3 or 4% per annum, and it's typically used for defensive purposes. So when you don't want volatility being the movements up and down in your portfolio. So if you had 100,000, if you don't want it to drop to 90 or kind of go, well, most people want it to go to 110, but where we know we may need to withdraw funds for a client because they may need it, their duration may be small, or potentially someone like yourself, Chris, if you're looking at actually just having a defensive play, if you're a bit worried about markets, and you just want to bolster up the defensive side, you can essentially hide out in cash. It's not there to make you rich. It pays a small interest rate. We can access it at any time. It's not locked away. But probably two things. Is there anything you want to add when we talk about cash? And also, why use a fund manager for cash? What do we look at there?
Yeah, sure. So, I mean, like you've covered off the main areas. I mean, liquidity is a big one as well in terms of having ready access to money, as you said, or the funds. The other thing where we might use cash in portfolios is where we're pretty clear on what we want to sell in a portfolio, but we're maybe not ready to buy something yet, or not clear on what we want to buy. So we may park money in cash as we sort of get comfortable or clarity on what we want to buy. So maybe a short-term sort of parking decision. If it's a medium to longer term decision, then it's more a view on markets and our concerns around market conditions and that sort of thing. So short-term parking, longer term sort of your view on markets and that sort of thing. But as you said, the return's low, and generally through the cycle, the returns on cash are lower than inflation. So the one key consideration for us is that, I mean, obviously the end impact for an investor or client is that most investors want to beat inflation in some way, shape, or form. And so we want to make sure that if we're making a distinct cash decision, that we know that the money is most likely going backwards on a after inflation basis. So we've got to be mindful of that when we are choosing cash in a portfolio.
So cash is the most defensive asset, and typically we would use it, or financial planners would use it as a defensive play. So if we knew we didn't want volatility, because, you know, for example, if you knew you were going to go buy a family car, you know, and you had to purchase that in the next 8 weeks or 12 weeks, you don't know what market's going to do in the very short term. If you don't have a long-term horizon, you would usually park it so that you know you've got that money available. If you know your rent's due or your mortgage is due, and you have to pay it at the end of the month, you typically don't want the swings and roundabouts, the ups and downs. You want to make sure that you've got a certain amount there, and it's usually used for defensive plays. We use it in the portfolio for defensive plays. As you said, it's usually not a long-term play because the rates of return are usually lower than inflation. So it doesn't necessarily drive the best outcome for clients as a long-term play, but for short-term plays, we can use it as a tool.
Yep. And you mentioned, Chris, the fund manager side of things. I mean, we can be a little bit more adventurous when it comes to definitions around cash and terminology around cash. And obviously the preference there is to keep it rather simple, to be honest. But there is ways of investing cash in other ways to generate a higher return. But again, we are conscious of the fact that that cash is generally for short-term needs. And so we need to balance out the short-term needs for that cash versus investing it in a fund manager where they may put money in cash or cash-like investments that have longer time horizons. So we have to make sure that we marry up the needs for that cash versus when we hand it to a fund manager where they might invest it, it might be a 6 or 12-month type investment, but that may not be in line with the needs for that cash in the short term.
Okay. If we jump into fixed interest, so now a lot of people probably don't know this, but fixed interest bonds, the fixed interest market, I think, is over 3 times bigger than the share market. So it's actually a really large, and it's a very sophisticated area. When we talk about bonds, the number one issuer of bonds is governments. So you've got the US running north of $30 trillion worth of debt. They issue bonds. So they'll go out, they will issue bonds. People will buy those bonds. They get cash for it. They will then pay teachers. They will then build roads. They will then pay the fire department, police, so on and so forth. So governments will typically issue bonds, and that is how they will raise funds. A lot of that, can be potentially purchased by their own kind of reserve banks or public fund managers, so on and so forth. And so there is a market for these bonds. A lot of times, bonds are typically sold at $100,000 a piece for usually a 10-year duration, but you can buy them all the way up to 30 years, or you can buy them with 30 days, 60 days, 90 days, et cetera. So duration is really important when we talk about bonds, and I'll touch on that quickly. So a couple of big things that I want to talk about with fixed interest. One, we've just spoken about government bonds, and we've spoken about duration, so the timeframes that you can invest. The next is credit. So credit is usually when we lend to companies. So when I look at companies, for example, Commonwealth Bank, when I think of companies, it's almost kind of thinking about it like your friends. So let's pretend that you've got a doctor, works at a hospital, he's been employed for 20 years, earns a good income. He forgot his wallet at home. He needs to go out and buy something. And he says, Chris, lend me $5,000. I'll pay you back. You might feel pretty comfortable at lending that friend some money. Let's pretend you have another friend who lost his job, has been unemployed for quite a while, asked you the same question, Chris, lend me $5,000. So typically there's 2 rating agencies. The biggest 2 that we usually look at are S&P and Fitch, and they will classify companies and governments through a system. So the highest rated system is AAA, and the Australian government has a AAA rating. If you go down that cycle and you look at AA, so I think maybe AA minus might be Commonwealth Bank. A single A rated company might be CSL. And someone like an Origin Energy would be a BBB. So you go from AAA, AA, and there's plus and minuses in there, AAA minus, AA plus. And so they keep rating it down. And the further you go down that curve, it means if, for example, there is a global financial crisis, if you fall on really hard times, the ones that are further down that curve are usually the ones that will fall into trouble first. But AA minus, Commonwealth Bank being it's very hard to get a AA minus. Not many companies would have it. And BBB in Origin Energy, a lot of people would be comfortable lending Origin Energy money at BBB. But then once you start to get below BBB, so, I was recently looking at it, Sri Lanka, for example, which is a government, they can print money. They've currently dropped from a CCC to a CC. So that means that once you move into below BBB and even into CC territory, it means there is risk that they're worried that they might start defaulting on money. It means the chances of you getting your money back continue to drop. If you go to a DDD, it means, with their own rating, it means that default is imminent. So when we look at lending money to companies, we typically won't drop below a BBB. Most of our money sits in that A category, AA category, or AAA category with governments. And so we're looking at the quality of companies that we're lending money to, making sure that even if things get worse, what are the chances we're going to get that money back? And that's part of the reason why fixed interest is defensive. So although people may think of fixed interest or bonds that you can't lose with fixed interest. But I just want to run through a quick scenario with you, and obviously jump in where you want. But let's pretend that with rising interest rates environments, so interest rates are going up. The problem with rising interest rate environments and fixed interest is if I gave the government, which again, AAA rated, one of the safest places you can put money right now is the Australian government and their ability to pay back money and different things like that. If I gave them $100,000 and let's say 6 months ago, they were paying a 3% yield. Well, that means I would get $30,000 or $3,000 a year. Over the course of 10 years, I'd end up making $30,000. So 3,000 times 10 years, $30,000. If they keep raising rates, 0.25, 0.25, 0.25, 0.25, 4 or 5 months later, they might be issuing bonds at 4%. Now, I haven't even received my first bond yet. It hasn't been a year. It's only been a few months. And for some reason, I might want my money back. I might go, Chris, you're thinking about buying a bond. Why don't you buy my bond? I'm going to buy a boat. I need that $100,000 back. And you go, sure, I'll buy your bond. Let's work out a fair price. Like you go, well, I can buy a bond right now issuing $4,000 a year. Interest rates are now 4%. And yours is only paying 3%. So why would I give you $100,000 if over the course of 10 years, I'm only going to make $3,000 a year, where I could go out and buy a brand new one at 4% and make $4,000 a year, i.e. make $10,000 more. Chris, you're going to have to discount me. I'll look at buying that bond for, and it's not necessarily a $10,000 discount, but, it might work out to be somewhere around an $8,000 discount. So you might kind of go, look, I'll offer you, and there's a present value calculation that you do to work out the purchase price, but you might go, given that you're 3 months in, and that, it's not, I'm only giving you 92,000 based on a return, it works out to about a 4% rate of return. And I think that's fair value. And I may, within a couple of months, investing in government bonds, lose $8,000 in that scenario. So duration is very important when you look at fixed interest. If interest rates are rising, you usually want to go short duration or go to a floating fixed interest rate. So something that moves with the Reserve Bank. If they jump by 0.25, there's investments out there that are floating, or there's ones that have short duration where you've only locked it in for 3 months. It has a very minimal impact. You get that rate of return calculated over 3 months, and there's no capital loss. But the idea, well, we don't know. So we don't know if the Reserve Bank is going to lift one more time. We don't know if the Reserve Bank is going to lift 2 more times. We don't, no one has that crystal ball. We continuously look at data day in, day out. We look at the jobs rate. We look at retail spending. We look at the unemployment rate. We look at a number of things, what currency is doing. There's all different types of factors on top of how long the Reserve Bank is happy to let inflation come down. So they've got target bands that they've set out where they want to see it at the end of 2024, where they want to see it at 2025. If they're at the upper ends of those target bands, they're more likely to put a rate rise in. If they're lower, then you might find that they actually start to cut or reduce, quicker. And that data is very live. We look at all different things, including what your top retailers are telling us as well. So whether it's over in the US, whether it's across the ditch in New Zealand, whether it's in Australia, but we look at all those bits and pieces to try and take our best guesses on where we might think they'll go with interest rates. And that's part of the reason why it is so important, because it's not just what interest rate you can get, but that you might actually, it may have a negative. So in a falling interest rate, if I locked it in at 4% and now you could only get 3%, well, obviously, if I wanted to sell that, you'd pay me more money for it. You'd go, Chris, well, I might offer you $110,000 or $112,000 for that bond. So by getting these right in a fixed interest environment, it can be very lucrative and rewarding. And so a lot of, I guess, what fund managers need to do, and also what an investment committee needs to do, is look at, well, are we investing in AAA, AA? A good example might be the Australian government right now might be offering rates of around 4.1, 4.2% for a 10-year bond. But then if you go to maybe a company like CSL, which might be an A-rated company, you might be able to actually get 6.5%, or 7%. You might be able to lock in a floating rate opposed to a fixed rate. And so not only is it who we're investing with, And it might be a mixture of each, knowing that this is defensive. People that are investing in bonds usually want it to be defensive. They don't want to be taking too much risk. So we're not looking at going too far down, but it's understanding the blend of those investments and then also really trying to understand the duration. So if we think that we're near the top of the cycle right now, in the sense that reserve banks are close to or finished hiking, then typically you want to start adding in duration. Based on what I said, you want to go longer. You want to lock in. If you think interest rates are going to fall, well, obviously, if you're giving your money, you go, well, keep it for a longer period of time. You can always sell it. So it doesn't mean that you're locked into that rate, and people will pay you a premium because you got a much higher rate than they did. But when interest rates are on the rise, you typically want shorter duration. Is there anything that you probably want to add there? I mean, how do you look at it? What are you doing when you're talking to fund managers? And is there anything that you think that I missed or you wanted to share when we talk about fixed interest?
No, probably the parts that we're emphasizing, Chris, are, I mean, it's obviously the defensive part of the portfolio. So we're always reminding ourselves of what part of the portfolio, what role it's playing. And we need to make sure that preservation of capital is key here. So again, you covered credit ratings at the beginning. The critical part here is if we're issuing somebody or giving somebody our $100, we want to make sure that we're almost virtually guaranteed to get that $100 back. Otherwise, it's not a defensive investment. And so the key criteria first and foremost is the credit quality and getting a comfort around that we're going to get that money back. Otherwise, all else is rather irrelevant, to be honest. The next point of call is then the return that you want to achieve. So what sort of return can you achieve for that given level of risk? And then the third element is around trading or strategies. So at what point of the cycle are we in? Do we want to take advantage of that point of the cycle or don't we? And then it's about like your levels of duration, like you mentioned, but also your levels of credit risk too. So you mentioned before the different credit rating agencies and their credit ratings. There'll be points in the cycle where economies are going well, employment's strong, corporate balance sheets are in good shape. And in that environment, we may actually come down the credit rating spectrum a little bit. But in environments where we've got a rising bad debt cycle, we think economic growth is likely to weaken, then we want to obviously stay at the upper end of that category. We want to be pretty clean when it comes to the credit risk we're taking, because again, we want to make sure we get that money back. So there's a variety of considerations there when we're looking at it from a committee level, but also in terms of the fund managers we appoint to manage the money. When we're speaking to them, we're generally having a two-pronged conversation around how they're positioned on government bonds and how they're positioned on corporate credit, and getting a feel for the transactions and the thinking around those parts of the portfolio. And it's a balance between opportunity and risk. Again, we're paying fund managers a fee to manage both risk and opportunity. We don't want it all to be about risk either, because we want them to take advantage of opportunity when it arises.
Right. And so, as I mentioned, fixed interest is over 3 times the size of the equity market. It is huge, and a lot goes into it. And in fact, you know, when we see interest rates increasing, it does have a big impact on the share market. So they are actually highly correlated. You know, the reserve banks or the Federal Reserve in the US, they use higher interest rates as a contractionary policy. So it means that debt costs more. Anyone that's paying a mortgage or companies borrow the same way that people that buy houses borrow to invest in their companies. When their debt costs more, it means they have less money to spend. And so understanding what's happening in the fixed interest market gives you a really good kind of macro sense on what's happening as well, or gives you a good idea on how well the share market might travel into the future and so on and so forth.
Yeah, I mean, we definitely use, if we're looking for ideas or views on certain things, it's usually first point of call is generally bond markets as a great informational source, because they sort of try and capture all informational sources and all data points, as where some of the other asset classes can be quite narrow in terms of their subsets or what they're looking at. So a great piece of informational source for us is just bond markets and how they're faring. That gives us a very good feel for the feed through into other asset classes.
Yeah, great. Let's touch on property and infrastructure. So what I might get you to do is just differentiate between property and infrastructure. Now, when I say property, I guess a lot of people, mom and dad investors, may think of real property, residential property. But when we talk about property, we're usually talking about the large office buildings in the city. We're usually talking about different things. Infrastructure could be anything from, you know, airports to tollways to dams that produce your hydroelectricity and different things like that. Those would be considered infrastructure projects. But do you want to elaborate on that a little bit, Chris?
Yeah, sure. So when we talk about property, we're generally framing it through the lens of what we refer to as commercial property. not residential property generally. And within commercial property, there's the three main subsets, if you like, and they are industrial, office, and retail, shopping centres. And that's what dominates most real estate markets, particularly locally. When you go abroad in real estate, though, or in property, what you do find is there's lots of little subsectors beyond that. So, so if you think about the US or in Europe, you have things like healthcare, healthcare related property. You have things like data centers. You have things like storage. You have other things like residential that's owned by corporate for rent. So in the US, that's referred to as single family and multifamily. So the sectors actually widen quite widely on a commercial property fund. So again, at the headline level, there's the three main ones. And then beneath that, there's lots of other subsectors we look at, even student accommodation, hospitality, tourism, accommodation type assets as well. It's a big range of property that we look at in portfolios. On the infrastructure side, that's, as you mentioned, we sort of separate that into two categories. It's what we refer to as user pay assets, so toll roads, airports, and rail, where they're sort of economically sensitive or economically linked, in that you do have to pay for the use of those assets. And so that can go up and down based on the economic environment. And then we've got more traditional infrastructure, which is sort of the core and boring stuff, if you like, which is regulated assets. So water, utilities, energy infrastructure, where there's usually a government contract or some sort of concession, and there's it's a sort of a necessity asset or necessity use need. So generally inflation protection as well. So we sort of separate them into two broad categories in relation to infrastructure. And the last thing I'd probably say, Chris, is, and we'll probably get to it as well, is obviously separating property infrastructure along those lines. We then traverse listed and unlisted. So we think about property that's listed on the stock exchange or available via listed means, and we think about property that's available via unlisted means. So, and there's obviously clear distinctions between how they operate, how they function, and how we invest in them as well.
Yeah, I'll get you to elaborate a little bit on unlisted versus listed. So when we say listed, it means typically listed on the stock exchange. So somewhere where it has daily liquidity. If I wanted to, so property in the city, let's say it's worth, $30 million and it may have 30 million shares. That means that each share is worth $1. And you may own $10,000 or 10,000 shares, or you may own 1 million, or so on and so forth. But people can go on and they can buy that. Now, if we're in a place where people are starting to work from home and essentially we know that those office buildings might only be 40%, 50, 60% tenanted, where before COVID, maybe they were 100% tenanted. And they, you couldn't get any office spaces. But if people have started to go from home, and then also same as mom and dad investors, now typically some of the commercial ones can't lock into these, 5-year plus fixed rate loans or other bits and pieces. A lot of them would be more on variable rate loans. But let's just say if they're rolling out of their loans and they've got to renew their loan, and before they may have locked in a 2.5%, 3% loan, and now they're locking in, usually higher than what you can get for residential. And so it might be at a 7+%. Well, on these $30 million, $100 million buildings or other bits and pieces, it's a substantial cost. A lot of people that go into property do so with a high debt level. It's rare where it's paid for by cash or 100% kind of owned. So whether it's listed or not listed, a lot of properties carry a debt against the asset. And if your rents are going down, so just purely because they're not tenanted, and in order to attract new people in, you may need a discount. If the building beside you and the building beside that also have 30 or 40% less tenants, you might find that you're fighting for tenants now because a lot more people are working from home. So when we look at these properties, if that is, potentially currently happening with some of the office buildings and other bits and pieces, the benefit of having a listed asset is that that's taken into account between the hours of 10 and 4, while the stock exchange is open. That is taken into account on a second-by-second, minute-by-minute basis. People are looking at the tenancy rates. They're looking if interest rates rise, they know that has a flow-on effect. You're talking about educated investors. And so you might see these properties that were once worth 30 million now trading for 20 million. There may be a discount there. And you can see it right away when you're buying a listed asset, because you're getting real live data on what that's being valued at. With an unlisted investment, think of your own home. When was the last time you had it revalued? What is it worth? if I put it up for auction every day, you would get one price point during the day, every single day. So I guess the big thing to know about here is when to go in or when to get out of unlisted assets. So let's pretend that you are dealing with a client and they have a large component of unlisted assets. If we think, we don't need to think, because we can look at what commercial property has done. We can see on the stock exchange. So if we look at commercial property on the stock exchange, you spoke about, we can look at specific companies that own office buildings or very similar kind of assets in a very similar area. And if they're down by 20 or 30%, if an unlisted asset, unlisted means it's not listed, hasn't been revalued for a year. So it's like getting a valuation done on your own home. And if you go, last year I had a valuation done, my house was worth $1 million. Well, if we know your neighbor has an identical property and he just sold for 850,000, I would go, well, my advice might be to sell. You may want to, if you can buy out right now because they haven't revalued that. And a lot of industry super funds, for example, do a lot of unlisted assets. And so, it can work for you. We could talk about the opposite thing, that if you are a retiree and you have a large balance, well, if they're holding a higher value on that property, you may actually kind of go, well, this is working in my favor, but only if you sell. If you're someone that's buying in, so if you're a wealth accumulator, you're salary sacrificing, you're potentially buying it at $1 million price when your neighbor essentially sold for an $850,000 price. And so it may work against you. So it's just really understanding the difference between unlisted and listed, and whether you're a buyer or seller, and whether it's working in your favor or not working in your favor. And so also with us, if we're working with any fund managers now, predominantly all the fund managers that we work with, we require them to have listed investments. If they have a very small portion of their portfolio in unlisted investments, we need to know about the specific holdings. We need to know when they were revalued. We need to understand all those kind of bits and pieces and what their get out strategy is, how they would kind of do it. So unlisted versus listed, a lot of people probably don't understand. And it is very relevant in Australia, because a lot of the large super funds do hold unlisted assets, and a lot of clients that don't know about when it's revalued and what the prices are may think that the returns might be a little bit better than what they are until such time as a revaluation comes through. And so it's always good to chat with your advisor and really get them to understand, what your current holdings are and who's using it. Is there anything you wanted to add there, Chris, before we move on?
No, I mean, the last thing I touch on is just in relation to, I touched on property and infrastructure in terms of what we look at within them, but then obviously we're looking at them across geographical lines as well. So we're not just looking at local property and infrastructure, we're also looking at offshore. And as you mentioned, with bonds being a much bigger market, obviously the offshore property and infrastructure markets are much larger, significantly larger. So we do definitely have a lens into offshore markets, but we don't ignore local assets either.
Great. Okay, so shares. Now, shares it's equity, it's a company. Now, typically when we talk about shares, again, we're talking about a listed share. A listed share means it's on a stock exchange. So you've got the Dow, you've got over in America, you've got the NASDAQ, you've got the S&P. In Australia, you got the ASX. In Canada, you got the Toronto Stock Exchange. In London, and you've got all different stock exchanges around the world, but it means that you can buy in their currency and buy out typically while that stock exchange is open. So very liquid, typically investments that are listed on a stock exchange. And what you're essentially doing is you're buying a share in a company. So if you buy a CBA share, CBA may have 100 million shares. If you buy one share, you own 100 millionth of that company. You actually own a small percentage of that company, which entitles you, if they earn an income, like how a property pays a rent, it entitles you to what a company would refer to as a dividend, which is the income pay. And if that company continues to grow, then your share grows. And that's kind of like the value of your house. If you bought it for $1 million, it's now worth 1.1 million. It's had capital growth of 10%. And it's potentially paid rent along the way too. So there's two ways you can make money from shares. It's through the income, i.e. the dividend. There's tax benefits through franking credits in Australia or other depreciation factors overseas. And there's potential capital growth. So that is a quick explanation of what a share is. And then I want to probably touch on where we can invest. So when a lot of people think of shares, they think of the Australian Stock Exchange. And the Australian Stock Exchange currently makes up, I think, less than 2% of the world stock exchange. So when they're investing in CBA or BHP or other kind of components, for example, I believe Microsoft, the company, has a bigger market cap. So if Microsoft was to liquidate and sell to cash, it's worth more than the entire Australian share market. So one American company, if you combined all the companies that are listed on the Australian Stock Exchange and sold them for, what might be $1.5 trillion, I'll have to check what the current market cap is of the Australian Stock Exchange. Microsoft would be worth more than all the companies combined in Australia. Apple, which was recently above 3 trillion, is worth far more. So maybe twice as much as, almost all the companies in Australia. So just getting a sense of, how big some of the companies are overseas, they're enormous. And a lot of people probably don't understand how big some of these kind of companies are when we talk about international shares and why we potentially invest overseas. So when we talk about overseas, the biggest market overseas is the US by far. It's like we said, Australia represents less than 2%. Even China, with the size of economy that it has, it doesn't have a huge, so it's the second biggest economy in the world. But again, it might only represent somewhere around that 2% of Australian Stock Exchange. So a lot of their companies, your Alibabas, different things like that, will actually list on American stock exchanges. Outside of that, we obviously have Europe and London. And so when we look at international shares, we're usually talking about first world nations, and that would make up also referred as the MSCI kind of index, which includes US. Then we also have emerging markets. So when we look at investing in emerging markets, these are, China would be the largest emerging market, but Brazil, Vietnam, other areas that would be outside of the main thing. So when I think of shares, I usually break them into three, which is domestic, international. When I talk about international, I'm usually talking about Europe, US, London, and then emerging, which would be your Chinas, your Brazils, Vietnams, and you can go on and put more companies in there, but that's how I'd break the three up. When I think about, we refer to blue chip. Blue chip means probably your bigger, safer companies. We spoke about how Commonwealth Bank has a AA- rating. Well, we spoke about the size of Apple. We spoke about the size of Microsoft. And so, if you kind of talk about blue chip quality shares, most of those are going to be overseas. You're going to have to go to the US to get those really large kind of components. And so it usually means there may be a lower risk factor with that. Not always, but sometimes by investing in a larger, more stable company, you may actually, just like with debt, you may be going down the risk cycle in the sense of how they may weather storms. Australia, we take no currency risk, and then emerging would be considered a riskier area. But in saying that, some of the emerging markets have some of the best population growth, have some of the, if you kind of look at India now, how they're kind of coming up, if you look at the growth that we've had in China, if you look at some of these bits and pieces, so it may be considered a bit of a riskier area, but we may actually see some of the best growth out of there over the medium term. When things are a bit volatile and we're a bit worried, we may not want to invest in those areas, or we just may want to use someone that's very educated as in a fund manager of what areas to invest in. But that would probably be how I define shares. And then probably what I'll get you to add on to that. And then we'll start to talk about, well, how do we pick how much emerging shares we have? How do we pick how much international shares? Are we throwing darts at a dartboard? Are we just kind of going, well, we just guess? And so I guess what I want to do is wrap some of these bits and pieces up and then start to talk to, well, how do we build portfolios and how do we think about what percentages to put in each? So we'll start off on emerging international Australia. Did you want to add anything there, Chris?
Yeah, so the way we sort of tend to frame the allocations to each of those three regions you sort of mentioned is, with reference to Australian equities, as you mentioned, it is a very small part of world equity markets, global equity markets. And so it does punch above its weight in terms of its size, in terms of population and the rest. We are actually a big equity market versus our economy and versus our population. So it does attract a higher weighting than it would otherwise if you looked at another country that was roughly 2% as well. But what I would say with the Australian equity market is there's some natural advantages to it that we obviously take into account, and that's yield. dividend yield. It tends to be higher in Australia than most other regions. And then also franking credits as well, which is a unique Australian thing, which isn't available around the rest of the world. So there is considerations for the Australian equity market, but we always keep in mind that it is a much smaller part of world equity markets, as you mentioned. In relation to global equities, obviously, as you've separated them into developed markets and emerging markets, the key consideration there is really around risk and opportunity. So in developed markets, you're going to get your larger, very large companies that are stable, sort of compound earners, if you like. But maybe lower growth. So they're going to be, for the next 20, 30, 40, 50 years, a regular, consistent type of return pattern. But you're not going to get the big swings of capital upside that you would otherwise get. And that's where emerging markets comes into it, where, like you said, you've got either economic aspects, so positive demographics, you've got underpenetrated markets when it comes to technology or banking and the rest. And there's a fair degree of significant upside over the medium term in those markets, given how underdeveloped they are versus developed markets. So there's some consideration there on a upside sort of opportunity basis, but also risk as well. As you mentioned, those markets are underdeveloped, and there is some risk there around rule of law, around geopolitical risks and political risks in general, and then also in terms of just even language barriers can be sometimes a problem, in that most emerging markets have company CEOs and CFOs that report in their language and then need to be translated to English before we can understand them. So there is some barriers to investments in those markets, but we do consider them a key part of our framework in terms of what we invest in. In terms of the allocations and the right sizing of allocations, the two things there would be risk versus return. So if we are allocating to something, we want to make sure that the return makes up for the risk or the additional risk we're taking. And then also what also dictates allocations is different points in the market cycle. So as you mentioned, if we're going into a riskier phase of the market cycle, we might want to rein back some of that risk to a certain degree, or we might want to lean into it and take advantage of it, given the rest of the market may be coming out of it. So there'll be certain points of the cycle where the market may not like emerging markets, as an example. And we look at it from a medium to longer term basis and go, well, that actually looks significantly cheap, not only versus developed markets, but versus long-term historical averages. And so we might lean into that with a slightly higher allocation. Again, we're not betting the farm. We're not putting all our money into that part of the market. We might slightly increase the allocation to that in terms of how we think about it, in terms of taking advantage of those opportunities. So again, it's a varied approach in terms of which markets we want to allocate to, and then also about making sure that the allocations are right sized to both opportunity and risk, and also the market backdrop or the environment that we're operating in.
Yeah, great. Thanks for that. I'm going to keep moving, then we'll try and sum all this up for everyone. But one other component that I want to talk about is currency. So we are currently unhedged. You can hedge currency. So what that means is if I buy a US dollar at 70 cents, if the dollar goes to 60 cents, 50 cents, 80 cents, I just go, look, I want it back at, the 70 cent ratio. So if and so someone will essentially take that hedge out for you, and you may pay a very small premium. Fund managers can usually do it for a very small premium, but they'll pay a small premium to go, we don't want to take on any currency risk. And they can hedge currency, which means that if the Australian dollar goes up or down, it doesn't affect their return. I'm just investing in Apple, I'm investing in Microsoft, I'm investing in Tesla, whatever it is, and I just want to buy the share. I don't want to take on any currency risk. Now, to just give an example, let's pretend that Apple was worth $100. I think it's currently about $175, but for this example, let's just pretend it's worth $100. If you were to buy an Apple share for $100, it would cost you somewhere around 143 US. That's assuming that the dollar was around 70 cents. Okay, so if the dollar was 70 cents, obviously for every $1.43, you buy $1 US. If the dollar dropped to 60 cents, all right, so if the Australian dollar went from 70 cents to 60 cents, and you own one Apple share for $100 US, it hasn't grown. It's the exact same price it was when you bought it. You bought it for $100. All that's changed is the currency. The currency's gone from 70 cents to 60 cents. Well, if all I do is now sell that Apple share for $100 US, I now have $100 US. When I convert it back, I'm now getting $1.67 for every US dollar. So I've made $167. Well, I get back $167. Essentially, I've made about a 17% rate of return. So currency can potentially work in your favor. I believe at the moment we are unhedged. So what am I saying about this? It means that even if US or our shares over in America, and I'll just talk US dollars, we don't just own US shares, we obviously own companies that are in different countries as well. But knowing that the US is the biggest market, predominantly most of our overseas exposure would be in US dollars. When we buy US companies, we have to buy them in US dollars. So we would have a large US holding through those shares. If the currency drops, which is currently done, if the market drops by 1%, but the currency drops by 2%, we can actually still profit out of that, or it can act as a bit of a buffer. And so, and then if we do think that markets have bottomed out, we also have the option to start to hedge so that we don't lose it all when it comes back up. You can speak with, obviously, your financial advisor. We could do a separate session on that, but I just want people to understand how big of a role currency plays when you're investing in overseas shares. And when we are, if you're currently invested, if you've already invested your money, a falling currency actually works in your favor. So if you're holding US dollars right now because you're holding US shares, for example, the falling US dollar potentially makes your return in Aussie dollars slightly higher. Anything that you want to add on there when we talk about currency, Chris?
Yeah, I mean, the key consideration there, I mean, one of the key consideration is if you think about the pot of money that's only invested in Aussie equities, and then we diversify by investing in global equities, one of the key considerations to going offshore is obviously a bigger, deeper market. So we're obviously accessing a bigger market in terms of global equities. But the other part, as you mentioned, is in relation to currency diversification in terms of when we go offshore. So we're actually taking on currency risk in other countries. And the reason why we think about it and frame it that way is that what a lot of people don't know is that the Australian dollars are actually a rather risky currency in the sense that it's commodity linked and China linked, as where the US dollar is a much stabler currency. Things like the Japanese yen are much stabler. So when we think about going offshore, we also obviously think about our currency exposures in terms of what we're getting in a portfolio, because it can actually help things like portfolio risk, portfolio diversification from a risk perspective. But then also we can take advantage of potential upside depending on currency movements. And what you do find through history is that as market environments get riskier or the sentiment is more negative, you tend to find the Australian dollar falls away and those other foreign currencies that I mentioned actually go up. And so we actually get the translation benefits back to Aussie dollar when we do that. So in the most recent period where the Australian dollar has been falling, our unhedged global equity returns have actually been higher than they would otherwise be. We've benefited from the fall in the Aussie dollar. And so that provides some upside. But again, it also provides natural diversification to the portfolio in that we're not just all Aussie dollar denominated. We've got a bit of US dollars, we've got a bit of Japanese yen, we've got a bit of European currency, we've got a bit of Great British pound. So that creates natural diversification to the portfolio, and that can be very handy from a risk perspective as well.
Great. Okay, so I want to wrap all this up and touch on a couple of different things. So what does it all mean? In defensive investments, typically we're looking at cash and fixed interest. And so your financial advisor that obviously chats with any clients will look at your personal situation, like we said, and through discussions with any end client, they will obviously figure out how much we should potentially be holding in defensive investments. We spoke about cash, we spoke about fixed interest, we spoke about duration, and what we would do in those areas to try and provide that defensive kind of component. Now, in the growth areas, we will typically be investing in property, infrastructure, and predominantly shares. And in shares, we've got emerging, international, and Australian. So what do we do? Do we just put 25% in each? Do we go property 25%, infrastructure 25%, Australian shares 25%, emerging and international? Like, is it just a flip of a coin? How do we manage this? And then is it also dynamically managed? You know, do we ever go, if we're worried about potentially people working from home, higher interest rates, do we lower our amount in property? Do we increase our amount in infrastructure? If we think something's been overbought, do we start to sell down from there? We've spoken about currency, we've spoken about potentially hedging, but what does the investment committee do, and how do we even start by putting these portfolios together? What are some of the thoughts we consider when we think about how much goes into the bucket when we consider building a growth portfolio for someone?
Yeah, so the first thing we start with is what we call a strategic asset allocation. And what we're doing there is we're actually putting forward a set of forecasts for all the asset classes we just ran through. So effectively cash, bonds, equities, property and infrastructure. And we use both history and forward-looking estimates to come up with return and risk forecasts for each of those asset classes. And so that sets that their long-term forecast, their forecast for annual returns for the next 10 years. We review them every year, but they are long-term forward-looking forecasts. And what that does is that then gives us a good feel for where we should be allocating over that period of time. So it's what we call a strategic asset allocation or a long-term asset allocation. Now, from time to time, there'll be adjustments required. And that's because even though we might be comfortable with our long-term forecast, what tends to happen during the period is the ride's choppier than we otherwise expect. So things happen quicker or take longer to play out than we would otherwise think happen to play out. And so what we do there is we might make adjustments to certain things, both from a risk perspective and of an opportunity perspective. So again, if we've got no view, meaning we're not strongly convicted in anything, we stay with our long-term forecast. We stay with our long-term allocations. But if we're strongly convinced that something has changed or there's a short-term reason to make changes, we make adjustments to those portfolio settings in terms of potentially a little bit more Australian equity exposure, potentially a little bit less property exposure. And what we're doing there is we're either doing two things. We're either taking advantage of an opportunity that's risen, so market has oversold or there's been knee-jerk reaction to some news, or we're taking risk away from somewhere. So we think that there's potentially more risk in that part of the market than the market's otherwise suggesting. And so we want to be a little bit more cautious and take some risk off the table. So it's always framed through a return and risk lens. But again, if we have no strong conviction view otherwise, we have a long-term framework that effectively gives us a path to achieving a set return outcome or a set risk tolerance. And so the committee is constantly talking about that and making sure that we're comfortable with the settings and then challenging those settings at every meeting. So where are we uncomfortable? Where are we comfortable? Where do we need to start looking at the next few meetings in terms of what does the agenda look like? And so we're constantly challenging that thing rather than just sitting on our laurels and saying, well, it's working, let's just accept that it is. It's us constantly challenging to make sure that we're comfortable through the cycle with that outlook and that asset allocation.
Right. Probably two more things I just want to touch on. I want to give people a picture of how big of a job it actually is. So, I mean, we've danced through some of these fairly quickly, but I believe in Australia just this week, it's a big reporting week for companies. So companies will typically come out and give you a bit of a health check and tell you how they're doing. So there's an expectation. Let's pretend you're investing in Commonwealth Bank. You might anticipate that they're going to pay a dividend they announced a $10 billion dividend. You may anticipate that, and maybe you thought it was going to be 9.5 and they've come out and beat your expectations. They've done 10. You want to look at, their net interest margins. You want to look at a number of different things in that company. But to give you an idea, the average company reporting pack is about 100 to 200 pages. And I think there was 145 companies that reported this week. And again, we said Australia represents 2% of the world stock exchange, and that's one asset class. We've got property, we've got infrastructure, we've got bonds, we've got all these different bits and pieces. So to just kind of paint a picture of what goes on, Chris, how big's your team at the moment?
So we're at the moment a team of 5 and growing. So and that's because there's more work every single day. So there's never a day where there's less work to be done in terms of information flow and news flow.
And so you've got a team of 5 analysts. Now you guys will deal with fund managers. So where the fund managers will work more closer with the actual companies, the stocks, they'll be the ones that go through those 145 kind of company reports, compare, well, is this company beating expectations, meeting expectations? What's their future forecasts? Do we think their share price is going to go up, down? You will then look at through their trades. You'll typically sign a non-disclosure with over, I think you look at over 100 firms. These firms need to be independently rated as top quality firms before they'll even get through to the likes of your team, which then you will start to compare them amongst their peers. And this is Australian share funds, international share funds, emerging market funds, property funds, infrastructure funds, fixed interest funds, cash funds. And we haven't spoken about alternatives yet, but they need to kind of hit a certain benchmark before your team will then start to compare them amongst their peers. They need to sign non-disclosure agreements so you can actually look at the trades they're making, and you can go backwards and go, well, why did you place that trade? You guys obviously lost out there, or you made a lot of money. What was your thinking? And you get a real sense working with some of these people for years around why we're using this Australian fund manager or that international fund manager. And then from our investment committee team, obviously, you've got me, Dan Rake, Stu, you have Ironbark that sit on it. We've got you that come in as a consultant. We've also got Toby, that's another consultant. And we also have Lonsec, that is one of the biggest research firms in the country outside of the Commonwealth Bank, that also sits on the investment committee. So just to paint a picture of how much work goes into it. And then underneath them is all the fund managers, where we will then place the funds. And we run ethical funds. We run high growth, high conviction funds. We run more passive funds. And then just probably quickly describing what is the difference between an index fund and an active fund. So if we look at a index fund compared to an active fund. So what we're obviously doing is what you would do, or the investment committee would do, would be considered dynamic in the sense of the changes that they're making over the top, predominantly using active fund managers underneath that are investing across specific parts of the market. I'll give a quick explanation of the difference between what I think index and active is, and then I might just get you to add in some parts. But at the moment, like if you think that we were going to go into recession in Australia or something like that, well, you would look at non-discretionary income. So retail would potentially be on the nose. You know, a Kohl's or a Safeway, if you still have to get your groceries, chances are you're still going to spend and you're going to buy. And in fact, they may profit because instead of buying the most expensive type of milk or peanut butter, you might buy the Kohl's brand or the Safeway, where they actually now make extra margin. So there's companies, depending on economic conditions, where you might go, well, we want to own more of that. But there might be, clothing stores. There might be things that maybe my pair of Nikes, I can go an extra 3 months with them before I need to update that latest one. Maybe there's bits of clothing or other kind of things that aren't essential. You might go, well, I might not buy that newest T-shirt or that latest bit and piece. And those are usually some of the ones, as people's purse strings start to tighten, start to miss out. Now, an active fund manager will look at markets. We've seen a lot of builders go broke lately. And so let's say that there's a lot of builders or other bits and pieces on the stock exchange. You might go, well, we want to carve that out. We want to invest in less of that. We want to carve out a bit of the retail sector. We want to invest less of that. But healthcare is still very important. We've got an aging population. We still think that, your Kohl's and Woolworths, other bits and pieces. And these are just examples. It's not telling anyone that's where to put your money. But it's assuming if you knew that a recession was coming and what you might think the future impacts. An active fund manager would start to buy more of certain areas. And then even between that, well, do I buy Kohl's, do I buy Woolworths, or do I buy both? One might actually look as if it's got far better growth. And so they might not necessarily buy both. They might only own one. Or, for example, you've got CBA, ANZ, Westpac, 4 major banks, NAB as well. You might only own one or two. You might not necessarily buy all 4. So an active fund manager will start to look at the entire market that they're playing in. Then they will start to shrink it and kind of go, well, what areas do I want to focus more in? And then out of those areas, is there specific people that I think that are going to do even better than others? And they will typically own a smaller percentage, where an index fund owns everything. If the ASX 200 has 200 shares in it, the index owns all 200 shares. Whether they think it's going into recession or not, it doesn't have that active management. And then a broader index, the All Ords, is it 500 shares, the top 500 in the All Ords? Then you get essentially
bigger than that, yeah.
Yeah. So you're buying every single share, potentially, whether they're potentially going bankrupt or not. If they're in the index, you're buying those shares, where an active won't. The obviously risks are, if the fund manager does well, they create what we call as positive alpha, what they're doing up and above the market. But if they get their guesses wrong, so, people don't have a crystal ball. There's plenty of fund managers, smart people out there that have made bad guesses. And so it's not just about, well, I've got a fund manager, I'll give it to it. It really is making sure, that you guys are doing your job, comparing them to the best, looking backwards and forwards. And with these kind of things, just making sure that we're making educated guesses around, this is what we believe is going to happen. This is our best guess going forward, but we've based it on a lot of research and education. And over time, if we get more things right than wrong, then hopefully that will lead to positive alpha for clients. Otherwise, you go into an index, which is a cheaper way to invest. So it means that there's less fees for fund managers. but you buy the entire index, the good, the bad, the ugly. Anything you want to add to that in between? What is the difference between index investing and active investing?
No, I think you covered it well, Chris. I mean, the key thing there is that we obviously cover both, and at different parts of the cycle, one may be more attractive than the other. At different price points, obviously one's more attractive than the other. As you mentioned, the passive tends to be low cost. But we do spend a lot of time on the active management side in terms of, like you said, making sure we are picking from the best quality managers in the subset. But then once we do get comfortable with them in terms of our longevity around analysing them and speaking to them, making sure they're sticking to their knitting in terms of their processes and how they manage money. So we spend an ordinary amount of time, like you said, picking apart what they're investing in, how they're thinking, and how they're trading things as well, because we want to make sure that if we are paying an additional fee above passive, that we're getting a reward for that additional fee.
Great. Well, Chris, I think that as far as this chat's gone, we've really given a lot of information and covered a lot of things off quickly. But if people wanted to have a helicopter view of what we do, it really is each asset class is its own asset class. A lot goes into that. The amount of research just in equities alone, like we spoke about, 145 companies this week just in Australia, average reporting document 100 to 200 pages, and it's not bedtime reading. We're talking about you've got to go through and crunch each number and look at all the accounting formulas and different things like that. Hence why you've got financial planners with investment committees, with underlying fund managers, and there's quite a bulk team that actually feeds all the way through before it hits someone's portfolio. Great. Was there anything else that you wanted to add, Chris, before we finalized off?
No, I think you covered it well, Chris. Like you said, there's a lot of things that happen behind closed doors that people may not be aware of, but it's good to bring them to light and sort of and show people how much work actually does go into the effort, because as we mentioned, there's a lot of moving parts and things are constantly changing, and we have to make sure we're keeping on top of things as they come through.
Fantastic. Well, thanks again for your time today, Chris. Always appreciated. And I'm sure we will do another one of these again soon.
No worries. Thanks, Chris.